So, what are the risks in regard to hyperinflation, and what contributes to it?
That's a good and topical question to bring up. Hyperinflation perhaps puts it too strongly at the moment, but inflation in Australia has, over the period of the pandemic, gone up considerably compared to the levels that it ran at. So this is consumer price inflation, as I say, the price of a typical basket of goods, so the electricity you pay for, the gas, the foodstuffs, etc., childcare and so forth. So we just had a couple of days ago the latest Australian Bureau of Statistics quarterly consumer price inflation data, and that showed a strikingly high quarterly increase. I think it was 1.3%, and inflation on average over the past year running at 3.5%, which is above the Reserve Bank's 2 to 3% target band. Now, again, we've got to be careful not to exaggerate. Just as I was saying earlier, I was frustrated by the Reserve Bank being fussed about whether inflation was a few tenths of a percentage point below the bottom of their target band. They equally shouldn't necessarily fuss about it being a few tenths of a percentage point above the top of their target band, especially given that we've had an extended period where it tended to be a bit below. Nevertheless, we are at a junction where, because of what's happening on the supply side of the economy and a lot of ill-considered government decisions that have disrupted supply chains, and also because of fundamental pressures on the way our whole globalized economy work, or what I hope will produce significant changes in the whole supply chain arrangements of our domestic economy, we are in a position where there's much more inflationary pressure coming through. And although that's true in Australia, you can see it's much more true even in America. For example, at the moment, we have 3.5% consumer price inflation over the last year. In America, it's 7%. And there are specific reasons to do with the way in which that's measured in America, which mean that's a huge understatement. So, for example, that counts about a third of the basket of weights for that increase in America. That 7% rate is based on cost of shelter, cost of housing and so forth. And the figure that's gone into that 7% per annum rate is the idea that housing prices have gone up. The price of getting a roof over your head has gone up by about 4%. But that's because of the long lags in the way that gets measured. If you actually look at what's happened to rents, as well as house prices over the past year in America, they've gone up by about 18%, 20%. So there's a lot of additional inflation already baked in that's going to come through as those lags wind off. And so America faces, along with various other effects to do with supply disruptions and insanely stupid government policy by the Biden administration and a raft of state governments there, the Californian state government, etc. They face a really major inflation problem. And the risk is in turn that will actually further generate for Australia inflation problems for us. But already we face a significant inflation problem which is exacerbated by the combination of the boost to the encouragement to people to continue to borrow and spend by extremely low interest rates. At the same time, as I say, as we have still significant supply chain disruptions in the supply side occurring from government policy in relation to the virus pandemic. So we're by no means at this stage in hyperinflation sort of terrain, which strictly speaking means the sort of thing we saw in Zimbabwe a decade ago, or in Weimar Germany, where you had inflation of 1 million or billion or trillion %. We're not at that level, but we don't need to get to anything like that level to have really bad economic outcomes. In the 1970s and 1980s, we had inflation average 10, 11, 12%. And that was extremely damaging to the economy, partly because of the way it interacted with the tax system and also because of what it did to interest rates. And again, we have a situation where even 3.5% inflation, if we were to be forced to try to get that under control by raising interest rates, we'd be forced to raise our interest rates from effectively zero at the moment back towards 3, 4, 5% levels, which historically would be extremely low. But at the moment, they'd be cataclysmic for households, because at the moment, households, for example, the debt level of households relative to their disposable income, that's risen. That used to be, go back to the mid-1980s, that used to be about 40 or 50%. So the amount you borrowed on average was about 40 or 50% of your annual disposable income. Now it's about 200%. So we don't need to get even to the sort of inflation rates that we had in the 1970s and 1980s before we could get a situation where, if that starts to generate a wage price spiral, the Reserve Bank will be forced to react finally, and that will have really major flow-on effects to the economy. The only way to break that spiral will be to do the sort of thing we did in the early 1990s, which is to create a really deep recession. And again, because many of you probably don't remember the early 1990s, unlike me, that was a period where the unemployment rate got over 11%. Now, we all fussed after the global financial crisis because for a couple of months, the unemployment rate got over 6%, briefly got to like 6.1%. 11% unemployment and youth unemployment rates, 35, 40%. That's what we saw in the early 1990s, and it went on for years. And that's the sort of dangerous terrain you get into if you start to let inflation get out of control. So you're absolutely right to be saying we ought to be worried about this and very vigilant not to let it get entrenched.